Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and odds are that you're watching this video because you got an email from me telling you that it's up. Now, I want to show you some interesting technical analysis charts of gold, what the US dollar index is doing, what global markets are doing, and what the S&P 500 is doing too. I believe that we're actually seeing gold in a buy zone right now. Uh, and the charts will explain why. But I know a lot of people feel a little bit uneasy uh, now with the markets because last week we saw the biggest weekly drop in the S&P 500 and in the NASDAQ so far this year. Now, we've had a tremendous rally too, but I was looking at articles over the weekend, and most of them, a lot of them are calling tops. One of them is making an argument, for instance, that yes, we saw a big rally last year that ended around Labor Day, and this rally has now gone the same amount of time, so therefore it must be about to end too. And we all know what happened after Labor Day. The stock market declined. A lot of people lost a lot of money last year, and that's why they feel very uneasy right now. And we've seen lackluster earnings reports from many companies. So a lot of people wonder how in the world could the market go up? But the internals of the market, they turned up in a way they hadn't done last year during any other market rallies. And more importantly, gold, silver, and global markets soared in November and in December ahead of the rally in the US stock market. They broke out above their 200-day moving averages in November and December when it took an extra almost 4 weeks for the S&P 500 to do so. The S&P 500 was following the action in global markets, and those global markets still look very healthy, as I'll show you an example in a moment. But first of all, let's take a look at a very simple chart of gold so we can see and understand what's going on with it now. As you can see, gold had a very powerful rally from November till just the other week. It went from 16.25 an ounce all the way up to 19.75 an ounce without any pullback until now. And now it is pulled back. It is now pulled back to the point where it's close to its 50-day moving average, which is the blue line on this chart. And the next support level below that is around 1835, 1840, roughly the 1/3 retracement level of the November low and its most recent high. So those are powerful support areas, which suggests to me that gold is now in a buying zone. The daily stochastics, the indicator at the top of this chart, is now registering an oversold reading by being below 20. Now, that doesn't mean gold is going to just soar next week all the way back up to 1975. It's most likely to go sideways. And I was saying that last week in the video update I did last Sunday, that the markets, all markets, we're in a position now to go sideways. You see, all markets pretty much reached an overbought condition on the daily stochastics and other oscillating indicators, but it happens to be my favorite. And then when you're in a uptrend, when you get overbought, typically those overbought conditions get worked off with sideways action. In a bear market, they lead to collapses or significant declines. In more bullish scenarios, which I believe we're in, they're worked off with sideways action, which can last several weeks. So I believe that's what's going on. So when I saw a couple of down days in the markets last week, it didn't really bother me or worry me because I think we're working off overbought conditions in a natural way. Now, simultaneously, the US dollar index is now overbought. The US dollar index tends to trade opposite to gold, or you could say gold tends to trade opposite to it. So while gold has been rallying now since November and has been outperforming the U.S. stock market since August, the U.S. dollar index has actually been declining since almost since around the end of September. And yes, it had a powerful rally last year when the Fed was raising interest rates by 3/4 of a point. That's what propelled that rally up. But now that the Fed has gone all the way down to raising rates by 1/4 of a point, and likely has one or two more rate hikes ahead of it, the U.S. dollar index has been declining. Now, finally, it got oversold enough in February that it bounced, and the gold dip coincide with that bounce in the U.S. dollar index. But now the U.S. dollar index is overbought just as gold is oversold. So it looks to me that most of the upside in this U.S. dollar index rally is pretty much over. If it goes up a little more, what's it going to do? Go up to 105 or 106, possibly 3 more points more. So upside is very limited, which makes me also think that the downside is limited too for gold. Again, I think gold and silver are pretty much in buy zones. Now, if we turn to foreign markets, and I'll just look at EWG, the ETF for Germany, to do this, what we see is that the German ETF, it got overbought too when the daily stochastics crossed above 80 soon as the year began. Now, it's barely pulled back at all. It's gone sideways since it's gotten overbought. And now the daily stochastics are plunging. In fact, they're likely to read an oversold level by going below 20 by the end of the coming week. So simple sideways action is leading to an overbought reading, which is going to become oversold by the end of this week. That's exciting. You see what I'm talking about when I say that in a powerful bull cycle, which this ETF is in, it's gone above its 200-day moving average in November, and this is now the third month above it. In a bear market, a market will trade below that moving average and it'll act as resistance. In a bull market, in a bear market, it trades below it, acts as resistance. In a bull market, it trades above it. It's trading above it. It's been above it now for what is going to be the third month. And instead of sharp pullbacks happening, we saw in December it got overbought and then became oversold by going sideways. It's now doing the same thing. That's the type of price action you see in a bull market. So you can also see the 20-day Bollinger Bands are coming close together. This is an ETF positioning itself to likely break out before the end of this month. The action in foreign markets, such as Germany, such as this ETF, is more powerful, more bullish than the action in the U.S. stock market, and has been leading it ever since this rally began. Now, that's good news for the U.S. stock market, even if it is trading weaker than this ETF, weaker than most foreign markets are doing. So, if we look at the S&P 500 now, yes, it's trading weaker than Germany. We can see, though, it's been overbought now for several weeks, and it's also in a position to go sideways. I saw people drawing charts on Twitter suggesting that, okay, we're overbought, we got a sell signal, and now we're going to the October low. Those people, though, are not looking at the fact that we're still above the 200-day moving average, which is currently at 39.44. Below that is the next level of support, the 1/3 retracement level around just 10 points or so below the 200-day moving average. The 50-day moving average is at 39.69. I would say we have a confluence of the 50-day, 150-day, 200-day, 1/3 retracement level all around, let's say, the 39.70 area to 39.44 area. A powerful support zone has now formed. So I think it's very premature for people to call a decline to the October lows. We're not even at that support level yet. We may not even get to that support level yet because this could easily go sideways. Look, this is not 2022. 2022 was a terrible bear market in the stock market. But before that bear market began, we saw in 2021 internal indicators, such as the percentage of stocks above their 200-day moving averages, top out, decline, warning that a terrible bear market was coming, or at least a 20% or decline greater move. And what happened by the end of the year, by the end of 2022, yes, the market averages dropped. Yes, a lot of people lost money and it was a tough year. But by the end of that year, the internal indicators all turned up. That sets the stage for this year, a year in which we're in a cyclical bull market. A cyclical bull market is not a bull market that lasts for 10 years. It's not a cycle like from 2009 to 2022 or something. It's a 2 to 5 year cycle. Probably we're looking at a 2-year cycle, but this is the start. And the presidential cycle aligns to that too. Typically, the market will go up in the 24 months going into a presidential election. So the trend this year is not like last year. This is not a relentless bear year. This is a sideways to up year. And when you have that is the global trend, what you see is that some markets will perform better than others. Some asset classes will perform better than the U.S. stock market. And that's what we're seeing in gold. Some world markets will perform better than the U.S. stock market. That's what we're seeing in Europe. And some sectors inside the U.S. stock market will perform better than the stock market averages themselves. That's what we're seeing. Focus on those to make the real money. Avoid the things that continue to lag. Avoid such things as crypto coins, such as the ARK ETF, such as silly stocks, such as Coinbase or Square or Zoom, which make no money, which were fad plays in 2021, and the revenues are still bad. The valuations are still bad. Focus on stocks with stable or growing revenue bases that pay dividends. That's what's working in this market because we don't have zero interest rates. When you have zero interest rates, what you have is a lot of people that feel that they can't make money in a safe way, and they feel like they're therefore forced to gamble. Now that people can make a return in the bond market, people don't have to take extreme risks to make, a return, and they're therefore focusing on stability, especially in a time in which, while yes, the market is better than the economy, and it's a lot of uncertainty about the economic situation. There's a lot of uncertainty about overall earnings. In fact, we're seeing a lot of companies saying that revenues may shrink. We're seeing a troubled technology sector that's being forced to lay off more and more people. We're seeing a decline in online advertising that's showing up in the earnings announcements of such big companies such as Facebook, so-called Meta now, and Google and Amazon. Amazon posted its first quarterly revenue earnings decline in years. But of course, these comparisons are going back to the boom times that these companies all experienced when all the lockdowns and shutdowns forced everyone into an online world and sadly, even online life. Now people are abandoning that. They don't want to live that way. Most people don't. They hate Zoom. They don't want to do these online conferences. They'd rather meet people in person. And that's where we're at. And that's why, a lot of these companies are not going to do that great this year. Avoid those kind of stocks and go for companies that you can see in your real world around you. That's what to focus on. If you like this video, hit the like button. If you want to get my next video update from YouTube, hit the subscribe button and then the bell next to it with this YouTube video, and YouTube will then send you an alert the next time I put up a video, and I'll be talking with you later.